Hello, welcome again to the Budgeting Immigrant Show. Once again, I am your host, Inosampao. Today, we're going to be talking about credit scores. This is the first part of a three-part series where we talk about credit scores, credit cards, and then loans and debts in general. So, let's get to it. What are credit scores? Credit scores are a specific set of scores or numbers that predict your credit worthiness or your ability to borrow money or the ability of a bank to trust that when they give you the money, you'll be able to pay them back. That is basically it. Nothing complicated. Where I'm from, we do not have a credit system. And I don't know how the credit system in all other parts of the world work. But in the US, the credit system is very important. The central economy of the US is based on credit. So as you arrive in the United States, you understand that living by credit is horrible. But understanding the credit system and applying it in a very meaningful way, and a way that sets you apart from a borrower to a worthy borrower, is important and vital to your survival and success in the United States. There are two types of credit scores. First one is the FICO score. That's what your bank is going to use mostly to determine your credit worthiness. The FICO score was developed by Experian. There's a lot of history behind it, and I know most of my viewers do not like the history part of it. It's boring. So I'm not going to talk about that. If you want to learn about the historic part of it, you can always Google the FICO score and you can read more on it, the history bit. But I'm going to explain it in terms of the money bit. FICO score is a set of scores between 300 to 850. There is FICO score 1, FICO score 2, FICO score 8, recently FICO score 9. There is also FICO mortgage, FICO car loan, all those other ones that you will probably never see on your own, but the bank uses to determine your credit worthiness. As I said, the FICO score was developed by Experian. Experian's other competitors, Equifax and TransUnion, developed the Vantage score, which is also a set of scores between 300 to 850 that does the same thing as the FICO score. Now, these scores are not just a bunch of numbers. They determine whether someone can be trusted to be able to access a specific amount of money that they do not have, but are hoping to be able to access and use. What determines your credit score, or what factors affect your credit score? The most important thing is your payment history. Have you ever borrowed money before? And if you borrowed the money, how good were you at paying it? This sounds kind of strange because to be able to borrow money, you need to have a good credit score. But without being able to borrow money, you are unable to actually assess the credit score. Which goes to another question that I'll answer later on the episode. Your depth of credit, which is basically how much you are worth in terms of credit or your credit limits, as most people understand it. Some people's credit limits are 500. Some people's credit limits are 5,000. And as you understand, if you have a credit score of 700 and your limit is 500, someone has a credit score of 700 and their limit is 50,000, you are both credit worthy, but you're on a different level of credit worthiness. Third one, credit utilization. That is your revolving credits and how you use it. You want to keep your credit utilization mostly under 5%. Most credit score apps will say under 10%, which is fine. But under 5% is where you want to be. Also, note, you do not want to borrow money you do not have. If you're going to spend $1,000 and you do not have $1,000 sitting in your account at that time to be able to pay off the $1,000 you're going to spend in credit, then don't spend it, because then you're going to struggle to pay for it. So be mindful of your credit utilization and how you use your credits. The third one, or the fourth one, is balances, which is kind of tied to credit utilization. The balances is how much balance you are carrying on your credit cards or on your loans or your debts. Balances is probably the most important part of the credit system because the credit system is based on the way the bank makes money from you is through interest, and interests are made on the balances you owe. So, for example, if you have a card right now, you probably want to ask, what is your interest rate on that card? The next one is your recent credit. Well, banks are very particular about who they are lending out the money to. And they want to know that you're not just going around shopping for credit. They want to know that you really, really need the money, but also you are not desperate for the money. So if you went to 10 different banks and they all bounced you, and you come to the 11th bank, they are most likely to also bounce you. You need, and this again is redundant, but you need to have a high level of credit worthiness to be able to access credits at one time and always get approved. There are people with 800 scores that still get bounced. So if you do get bounced when you're looking for credit, don't get offended. Every bank has its own system. I've been bounced multiple times, and 3-4 months later, I try to access that credit line and then I receive it. Mostly the reason why I'm bounced is because the banks felt I had in recent times shopped for credit, and so I was kind of desperate for money. I wasn't. Let me state that. But the bank does not care. How much you shop around determines how desperate you are. The way you can work around this particular one, the recent credit, affecting your credit score but not affecting it drastically is, and this is the first tip I'm going to give. When you access a credit line for the first time or you begin the application of a credit line for the first time, it opens an account for you on the credit score system with FICO Advantage. And you have 30 days to shop for credit without it affecting your credit score. So in that 30-day period, you can shop for a million different credits and it affects your credit score once because that first application you did has already affected your credit score. Once the 30-day period is over, if you go search for credit again, then it's going to affect your credit score like you started the process anew. Again, with recent credit, you hear of terms like hard enquiries and soft enquiries. Hard enquiries are when you go to buy a car, or you try to apply for a credit card, or you try to apply for a personal loan. Banks will do hard enquiries on you to verify, do you have any debt? What's your address? Do you owe on your rent? Do you owe on your mortgage? Basically, they would go hardcore on you on your financial ability. That hits your credit score. And you want to pack all your hard enquiries within a 1 month period for it to affect your credit score once. Then you have something like soft enquiries. Soft enquiries come in play when a credit bank or a credit union, whatever, whoever is a lender is going to borrow you money, wants to assess your credit, but not necessarily for all the things I had mentioned previously. So the best example would be if Barclays, for example, wants to increase your credit limit because this guy has utilized his credit really well and his revolving credits are excellent, then they're going to run a soft inquiry on you. And if everything comes out correctly, they increase your credit limit. If you contact Barclays on your own to increase your credit limit, say you had 500 and you say, hey, I need 1,000, can you add an extra 500 to my 500 so I can get a credit limit of 1,000? That's going to trigger a hard inquiry. But if Barclays does it on its own for you, that is a soft inquiry. When you go to rent an apartment, apartment companies, apartment complexes normally run soft inquiries on you. So these are the most important parts you should remember when it comes to credit cards. Then there is the available credit. If you have a credit limit of 11,000, we've talked about credit utilization, and you utilize 10% of it, which is 1,100. How much do you have left? You have 9,900 remaining. The available credit determines how good you are with being able to handle a large chunk of money. So my credit limit could be roughly 100, 120, 130,000, and you could be walking around with that amount of money in your pocket, in your wallet. If you spend all of that money, that hurts your credit score. Not as important as the payment history, but it hurts your credit score. You always, like I said, with credit utilization, want to keep it under 5%. So you want to make sure your available credits at all time is around 95%. If you want to go deep for any emergency situation, keep it at 90% and your credit utilization maximum 10%. Then the final one, the most important bit, the credit mix. Most people say, I have a credit score of 775, 780, 805, 810. That is great. But if you run a credit score based on just your credit cards, banks do not trust you enough that you can go beyond that. You need to have a good mix of credits. There is the personal loans, mortgages, car loans, and then credit cards. All these are credit mixes that come together to form a credit opinion of you. You mostly would not see this as a percentage listed in your credit score app, but that is a big factor in your credit worthiness. If you have credit cards totaling $10,000 and you want to go buy a car worth $40,000, the bank at that moment cannot trust that you can actually or would be able to actually pay for the car because your credit mix is not really strong. So you're going to have a interest rate higher than the average because of this. If you want to buy a house of 360,000, 500,000, and your credit mix is just credit card with a $10,000 limit, you're going to have a higher interest rate. You are getting the sense now. Low credit scores, higher interest rate. Any doubt of your credit, higher interest rate. Interest rates are the ways the bank use to secure themselves that when they give you the money, they are not losing anything on it. Interest rates are important because that determines how much you're going to be paying in the end. The interest rate is the difference between you saving $200 and you saving $500. For example, if you're going to buy a house in the current market where interest rates are on average 6.875 and your credit score is not strong, or your credit mix is not strong, or your credit utilization is a little bit above 10% of your total available credits or income, then you're going to have a situation where the banks have to secure themselves with a higher interest rate. This is because as you're paying off the debt, you pay the interest first before you pay the principals. So the more you pay with interest, the more secure the loan for the bank. If you have a high credit score, then you get lower interest rates. Lower interest rates is the reason why you need a credit score. Like I mentioned earlier, the US economy is built on the credit system, and having lower interest rates gives you the opportunity to buy stuff and to be able to pay it back without losing a lot of money. You've heard of 0% interest rates, 1% interest rates, 2% interest rates during the COVID time. Most banks will reach out to you with 0% interest rates. Those are because they feel you are financially sound and secure, and you can go and spend that credit card or the money on the credit card, and they can give you a year or two of 0% interest rate for you to pay it back. So basically, you're paying exactly what you borrowed, no debt. But if your credit score is not strong enough, you do not qualify for these privileges. Thank you very much. Next week, we're going to be talking about credit cards. People have reached out saying, what are the hacks of credit cards? Those are informations that currently might help, but it's not essential for you to be financially strong. So, as we're talking about credit cards, I'll talk about the importance and the usefulness of it and the hacks that will benefit you. The hacks like flight miles and stuff. Reach out to me personally if you feel you are there and you want to start doing that. But for now, thank you. See you next week. Bye.